All right, good evening, everybody. Happy Sunday. It is February the 27th, and it's about 5:15 here in Toronto. I'm your wealth guy. Let's talk money. Let's talk Sunday market preview for the week. But before we jump into next week, let's take a look at what happened last week. As you know, that's my regular thing to do. So last week, Thursday, we saw the market, especially pre-market, tank roughly 800 and 900 points, and it swung all the way back around and finished roughly 100 points into the green, actually just shy. And then Friday, another 100-point move to the green. Now, overall, I did tell everybody that in the event that a war did break out and Russia did invade, we would see a major pullback in the market. I also said that that pullback would be bought up incredibly quickly and it would be moved right back up to the positive. Now, I can honestly admit I didn't anticipate that it would happen that quickly as far as the buying back is concerned. And to be honest, I thought that it would be a little bit more to the negative. I was expecting more 1,500 points. But still, at the same time, the premise was right. The markets bought back everything and then some over the next day and a half. Now, what I will say is this week coming, you can expect, again, more volatility. And that's probably because Russia decided to use the term nuclear. And they've essentially set up or put their nuclear deterrence system on high alert. At the same time, to counter that, not necessarily from a military perspective, but more of a financial perspective, regulators have put a certain number of Russian banks or cut them off from the SWIFT system, which for many of you who don't know, the SWIFT system is essentially the transactional system or the system that allows transactions between financial institutions. And so they've cut off a certain number of banks. And again, there was no actual disclosure to how many and which banks in particular. So it could mean absolutely nothing in the grand scheme. Or it just means that certain banks were, and there's always a workaround. It's just the nature of the system. So I do expect volatility. I wouldn't be surprised if tomorrow we saw a little bit of a pullback, some of those profits taken back. But again, I'm still believing that you should stay long at this point in the market. I don't think that this war is actually going to be a negative. And part of the reason is because the war is allowing the Fed and central banks around the world to continue to inflate by printing more money to fund the military-industrial complexes around the world. In other words, inflation will continue to skyrocket. And even if we take a look exclusively at the US, will the Fed raise rates? I really hope so. I hope so, at least a little bit. I'm not going to call it a hike. I anticipate, a marginal increase in March, ideally somewhere around the 25 basis points. But the Fed needs to raise them even a quarter point. And the reason is because the markets want that. So the markets will be happy with something, just so that the Fed can show that they are doing something. Will it make a difference overall in inflation? Absolutely not, especially with this war. Inflation is going to continue to soar and go out of control. But there are ways to mitigate your risk. So one of the areas I'm looking at for the rest of the year, and I actually touched on it in January when I did my market preview for the year, is energy. I anticipated that energy will absolutely soar, and I do continue to believe that we will have a global energy crisis. And so I'm preparing my personal hedge using energy to my regular positions. Now, that's not a recommendation for anybody. That's very specifically how I'm treating my personal portfolio. But I do anticipate that energy, even though I looked at it more Q3, Q4, along with precious metals, seems like we'll be moving sooner than later. Now, that being said, we did touch on precious metals, so I anticipate precious metals to also continue to move to the upside, not quite with the same aggression that we saw over on Thursday, where gold was roughly up $70, $80, if I remember correctly, at one point, but is now pulled back and it's below 1,900 as of close on Friday. Now, I do anticipate that that's going to change and continue to move to the upside. In any case, the major issue I do want to point out here, the major thing I do want to point out into give some confidence into my belief as to where the market is going is the 10-year yield. Because you see, the markets themselves, where most people are looking for answers, aren't necessarily directed or not necessarily the result, or a better word would be the markets themselves are a derivative of the debt market. So basically, the debt market will determine the actual direction of the market. And one trend we did notice throughout all the volatility over the last few weeks, with the exception of a few days where the 10-year yield did spike up and spike down, the 10-year yield has barely moved at all. And when it did move, it moved very slightly one way or the other. Now, currently, the 10-year yield is around 2%, and I think the market has accepted that it's going to be about 2% or higher. But by no means did the market actually spike. So until that happens, you can anticipate that the markets will probably continue to trend upwards and continue to hit all-time highs. In fact, I'm calling all-time highs. I'm calling all-time highs over and over until we see a spike to the upside in the 10-year yield. Once we see that happen, and I mean a big spike, that will be the trigger that'll cause the markets to pull back and collapse. That's really all there is to it. As long as the 10-year yield continues to show stability, we will continue to see higher markets. Now, if we talk about inflation again, the US dollar in particular, global currencies in particular, we can anticipate that inflation will continue to erode currencies around the world. Even if the US dollar shows that it's actually in the green, keep in mind that is all relative to other currencies, not factoring in inflation. So in essence, the US dollar really doesn't matter as it continues to crater with all other global currencies as inflation continues to eat away at the value of your dollar. But I think that's it for today. I do have a bunch of other notes, taking a look at back-to-backs. You know what? This video's already gone a lot longer than I like it normally. And you know I never script anything ahead of time. So I think that's it for today. If you have any questions, feel free to send me a message. Otherwise, everybody, feel free to hit that like button, subscribe. I'd really appreciate the love. Until then, I will see you at the opening bell.